Myself, I'm Lee Bressler. I lead the U.S. capital markets business for Microsoft. And in that role, we cover investment banks, asset managers, exchanges, all the participants in the capital markets. With me, I've got first Howard Lutnick. Howard is the chairman and CEO of Cantor FitzGerald and BGC Partners. Cantor is the largest wholesaler in the fixed income markets. BGC has large businesses across the entire spectrum of finance and real estate. Howard is also the founder of the Cantor FitzGerald Relief Fund and is a major player in disaster relief efforts. Then I've got Yorke Rhodes. Yorke is the co-founder of the blockchain group at Microsoft and is a leading figure in helping companies figure out how to use blockchain, what flavor of blockchain to deploy in their business, and how to really make the most of it. And then last, I've got Joe Lubin, the founder of ConsenSys, and prior to that, the founder of Ethereum.
Co-founder
of Ethereum. And Joe has also had a leading role in the Ethereum Foundation. Is that what it's called? That sets the industry standards?
Early on I did, but
okay.
It would be unfair to say that I still have a role on the foundation.
Fair enough. Okay.
But we work very closely with them.
Okay. So we've got this panel, and what we want to talk about today is the investment bank and how it's changing, how the capital markets are changing. Is there a change in the business model that's required for these firms, and how should they organize and respond to those market changes? So, let me grab my list of questions here that I'd like to run through. So, first, I think an interesting one along that theme is we've seen an evolution from the ICO to the STO. The market is small, but it's growing fast. So let's talk about asset securitization and how that could potentially disintermediate investment banks. So Joe, maybe I can start it off with you, and we can start with that one.
Sure. There has been a fair amount of fear, uncertainty, and doubt about raising money using tokenized mechanisms, and about what these instruments are that people are selling. In many cases, people are selling instruments that could be considered consumer utility tokens and would not, according to Bill Hinman, Director of Corporate Finance of the SEC, be considered securities by the SEC if they're structured properly and if they're marketed properly. So you can't create a perfect consumer utility token for your GPS beacon platform and then sell it in enormous quantities to speculators. And you can't put billboards in Times Square and sell a token without without drawing the attention of the SEC, negative attention. So we anticipate that there will continue to be many consumer utility tokens. There was a few successful ones over the last handful of months. Certainly creating or using this new technology for securities, for equity, for other kinds of issuances makes a ton of sense. They're just going to be much more fluid to create. They're going to be more fluid to transact in. Having programmatic shares will just enable us to imbue them with more capabilities. They will be uncounterfeitable if properly executed. So there was a case where the Dole Food Company, there was a purchase of the stock, and then there was a judgment that the purchase was done at too low a price, and so people wanting to get their funds from the judgment essentially submitted their claim, and the date of record had one set of people at listed at the DTCC,
Right.
but because clearing and settlement extends over 3 days, there is another set of people, not exactly the same, that are registered at the different brokers, and so 140% of the shares showed up to collect some money. So that'll be effectively impossible on a blockchain system. The big takeaway is that capital used to be the most important thing in the investment space, and that's actually changing because projects can access capital globally, because capital can move really rapidly to a good project, because really good projects can create magic internet money and trade that magic internet money for
That's the good stuff.
for work and for technology by people who believe in the project. It's going to be all about creating engines for ideas. So creativity is going to be far more valuable than money as we move forward with these systems.
Howard, could we get your take on that view that capital is maybe not the moat that it once was for an investment bank?
Well, I think if you start at the top and you work your way down, it's like sedimentary rock. There's different layers. So at the top, let's say there would be Uber, and Uber can go public in any form it wishes, because it would agree that the global perception of buying Uber does not need really marketing, doesn't need capital. It's really distributed well. Ant Financial would be another one that's distributed well. I know some people who invested at 150 billion market cap and got no financials, right? So that would be an example of it's just big enough that people are willing to play. And then you have the bottom, which is what you're talking about, which is these these new internet ideas that people are willing to invest in as a speculator on a flyer. And they would be willing to buy it without validation and without certainty that they would get from an underwritten investment bank. And then you have all those companies in the middle. And all the companies in the middle need analysts, they need underwriting, they need validation, they get credit, right? They get credit, right? Most companies that go public have borrowed a revolver from the investment bank that's choosing them. And all of that in the middle is moated, in my opinion. So I think there's space on the bottom. I think there's space on the top, classic barbell, but the middle is seriously moated with companies with huge amounts of capital that use that capital to protect themselves. And let's face it, if I'm T. Rowe Price and a company's going public at $4 billion, right? I need someone to validate it. I need someone to study it. I need someone to watch it. I can't watch it. I need an analyst who I trust to tell me, are they sticking to their numbers? Are they doing well? Are they doing poorly? I can't do that myself. And so I think it's a barbell.
Yeah, I have to agree with that. People in our space have been quite naive. It was a lot of young technologists who were trying to do things that investment industry professionals had been doing for decades, and people were naive in the sense that we thought that if you were going to try to introduce a protocol and sell a token that represented utility on that protocol, you really only had one shot at it. It was one and done. You're making this agreement with the people who are using your system, and you couldn't do it in 3 rounds. You couldn't bring some capital in, do some validation, bring some more capital in, do some validation. And so we absolutely need to bring the decades of expertise into our ecosystem. We're starting to see that already.
Now, we've seen a couple of big name IPOs that have sort of bypassed the traditional capital raising model, right? Spotify last year, Slack just announced that they're doing that this year. So, I'll start with Howard, but I'd love to get everybody's take on this. Is that going to be the model of the future? Are they able to do that just because they're the Ubers, they're the biggest brands out there and no one else could do it? Or is there the start of some trend here where capital raising is really going to be a different process?
So people love to talk about 7% for an IPO, right? For decades, how could it be 7%? And the answer is 259 companies went public in the United States last year. How many have you heard of? right? If I said 20, right, I'd be pressing the furthest edge of the envelope possible. So those 20, 15, maybe 10 of them can choose another path because they have notoriety. But all the others, right, the other 90% have no customer. Let's say you're a manufacturer. You're anything that's wholesale, B2B. Who's ever heard of you? Right? Nobody. So you need marketing. Well, first you need validation. Are your numbers actually correct? And we'll get to where Yorke will talk about that eventually people can do machines can do deep learning to validate. But they need validation now. They need analysts now. They need capital now. And they need underwriting. You know what underwriting means? It means you're going to buy the security and you're not going to rely on the company, which could be a fraud. Right? You want me, the big investment bank, in the middle to say, if they're a fraud, I have a deal with them, you have a deal with me. So if you trust me, I'll validate them. You sue me if it's a bust. And so for the 225 companies that are lower than the top 10%, I think it's really moated, right? And moated for a good decade. Now, as quantum, as deep learning gets better and you can start to extend that, but I think from the bottom up and from the top down, that'll extend. But the middle is moated for a good long time.
So, I mean, you just sort of defined 3 criteria for investment banking, which is access to the market, risk mitigation, and reputation, right? And if you could replace those 3 things, effectively then you could disintermediate or disrupt this particular market. Would you agree with that?
And I can name a platform that's trying to do that, actually. So we have a project at ConsenSys called co-venturing, and it essentially contemplates that all the expertise that you're discussing could be brought to bear on different opportunities in an open venture capitalization platform. So the idea there is that, similar to the way the industry works, projects are identified. It could be prospectors scouring the world. The projects are introduced to the platform and they are staked. So there's a security bond placed in order to get the project on the platform. Diligencers from around the world, not just from one company or one company and their cronies that talk about the same deal that they're looking at, but different subject matter experts from around the world can take a look at this project, diligence the project, share their research with everybody on the platform. And then investors are sitting there watching this activity. The investors can say, that's a crappy project. You're wasting my time. I'm going to take your security bond. Thank you very much. Or they can say, this is a great project based on the research that the diligencers have done. Thank you very much for putting it on the platform. We're going to invest in this project. At that point, the diligencers can either get some of the carry or some of the equity. There are different models that we're working on, and the prospectors can get paid as well. And so in this kind of situation, you really can bring some of the best research to bear on this project. The project itself could have a more diverse network of investors, and you could potentially see a much broader profile as an investor.
So the way I would look at it is, if you bifurcate all the pieces, right?
Yeah.
When people try to bring it all together, like an investment bank, I think the investment banks are great at it.
Sure.
If you bifurcated the piece and said, all right, let's just do research.
Yep.
Can't we do research, right, with machine learning and, let's say, a broad consensus of people? Can we build research as good as one person who's covering 50 companies with 2 analysts? The answer has to be yes.
Yes, absolutely.
It has to be yes, right? Can we do capital, right? Can we democratize capital and say, would you participate like an insurance, like democratized insurance? Would you underwrite this? And let speculators come in together and underwrite that from a capital perspective. And if you could raise enough for research and you could raise enough for capital, then wouldn't you be able to say, right, if I could bring in the company, now all you need is a sales force.
Right.
And can you build a sales force that would sell that, and then you could shred the other two and change the way it works. But until you can do those two things, as long as people are trying to do it all together, I think the probability of success is low. As soon as they start to split it and be expert at A and expert at B, eventually the 7% will come down, but it needs A and B and ultimately a Salesforce of C.
Sure. So I think on an open platform, the world can be your Salesforce. So you can get a broader selection of different projects globally. And in terms of diligencing, I think the industry often suffers from groupthink, where people are doing the same sort of pattern recognition, and having a much broader set of eyes taking a look at different projects, I think will be healthy.
Yorke, could you talk a little bit about how AI and machine learning can drive changes in that research process, can help automate some of that research process, and really take that work away from people or make it somehow more precise?
I think what you'll see in the beginning, and this is the case with most learning systems, is you have to have guidance, appropriate guidance, and so I think we would rely on the researchers within the investment bank to actually provide that guidance. As a validated, reputable firm, that the outcome of the learned system is actually coming from, a Cantor or Goldman Sachs or someone who has a reputation, and therefore the results of it are actually valid, right? So that sort of goes back to the point, the general point about reputation is critical, because otherwise people won't believe, right? And so democratized reputation is certainly, I think, something that we can provide if we have access to the data. And then, from a learning systems and AI perspective, data is what drives it, right? And so wherever that data comes from, it certainly is what's going to drive the engine.
Now, for a long time, the exchanges have been the intermediaries in parallel with the investment banks at the center of much of this activity. And we've seen the business of the exchanges change. How is that, what is that going to look like over the next few years? Is it going to still be a battle over latency? Is there some other trend we need to be looking for in the exchanges?
All right, so let's start just to understand the basics, which is equity microstructure, meaning the chopping up of trades into little bitty pieces and electronically selling them at the average, has occurred because the investment banks have ceded market making to professional trading firms, right? They have decided that the arms race of technology is not worth it to them, so they've ceded it to market makers. And by the way, the market makers win until they lose, right? So they build these great supercomputers, they're doing really well, they make money, and then someone does it better than them, and then they have a family office. So they go from making money, and then it becomes a family office. And I've seen it time and again. So trading has gone to market-making firms and continues to go there. Sales has been automated. Now it's currently an RFQ system, and that is anachronistic just in and of itself. It just is an email system, which is fascinating that that's the way the world works. But at least it's not a salesman, right? And ultimately, the exchanges win in this model, right? Because there's more volume and more volume. Fixed income is going not exactly that same way, but intellectually the same way, which is that ultimately the marketplaces, which BGC Partners is the largest in the world, are winning in that model, right? And you've seen the CME bought one of our competitors for $5.5 billion because they wanted those pieces in the exchange in fixed income. So that's a model that's growing and growing. So I think sales and trading is going to continue. Traders are going to be replaced, right? Are already and will continue to be. Sales will change and will come better and better at a way to integrate a buy-side firm with opportunity to purchase, right? So that's going to happen. And therefore, the exchanges or marketplaces will continue to be winners in the space because people need a place to trade with each other. So whether you call it a marketplace, whether you call it an exchange, it doesn't really matter. It's a place where people can trade with each other that's trustworthy and works. And those markets will work however form they are in existence. They will be ultimately continue to be winners granted at a much smaller scale because the banks make so much money and exchanges make so little comparatively that it's great for the world, but the exchanges are winners.
Yeah. What's the biggest consumer exchange in the world? Amazon, right? And all the brands recognize that, right? So initially they were like, no, we wanted to go on our own. We want our own website with our own e-commerce. But ultimately they had to go where the volume was, right, to get to the consumer eyeballs.
Right.
Yeah, so I think one breakthrough that we're going to see over the next few years, and the technology is still a bit immature, is just greater transparency into how trades get done on markets. So if they're done entirely in the open on a blockchain, maybe there's an order book that is off blockchain and the matching engine is off blockchain, but it's still essentially transparent. We can start to perhaps segment the kinds of trading that gets done. Most people probably don't need to be involved in an infrastructure that supports high-frequency trading. And certainly high-frequency traders bring liquidity to the market, but they're also essentially giving Joe Sixpack a haircut all day, every day, basically pulling value out of that market. There is technology. Gnosis is a project that externalized from ConsenSys quite a while ago. They're building a reverse Dutch auction decentralized exchange where they're trading initially in experimental phase every 6 hours. So a whole bunch of orders come in and they match the orders, they optimize them, and there's a single price that everybody gets. And so fair trading, slow trading, sort of like the slow food movement, there will be use cases where this sort of transparent, fair pricing can be applied to certain kinds of trades.
Well, but I'll give you an example. So high-frequency trading for liquid stocks sort of seems obvious. Market makers create prices that when you want to sell, there's someone there to buy it. If there was no market maker, the spread would just be wider because no one's interested. In less liquid instruments, we have a product in the world called volume match or credit match, which is we run an auction, but we set the price. So we set what we think is the fair mid price or the lowest price you'd be willing to sell at without throwing up, and the highest price you'd be willing to pay without throwing up. We set the price and hold a non-price discovery auction. And the most successful fully electronic model in the world for illiquid instruments is that. I mean, people just, you want to participate, yes or no? It's through your firewall. No one knows you're participating. So the problem with most illiquid instruments is if I tell someone I want to sell 100 million of it, it just dropped 10%. Right. So I can't even tell you I want to sell it.
Right, word spreads fast.
Right, I can't tell anybody, I can't trust anyone, so I need to find a way to transact without disclosing it and having no transparency. And we've designed models, so new models will occur all the time, but they already are in existence and building all the time. So that's called a volume match or credit match. It is the most successful way emerging markets trade today in the wholesale market.
Interesting. Now, do you see, one of the things that Joe touched on was the mom and pop traders and the high frequency guys taking a haircut away from them. And that's specific really to the equity markets. How do you see regulations evolving to deal with that? And do you see a different path in other markets where there isn't a mom and pop presence that has to be protected in the same way?
Look, I think that the SEC and the global regulators care about mom and pop who vote. Mm-hmm. And those people buy equities. Those people don't buy fixed income. They don't count as speculators. They don't count all the way. So what's going to happen is there can be an entirely different set of rules for everything that mom and pop does not ordinarily invest their pension in. Mm-hmm. Right? And those rules are going to be different. They just can't get ripped off. So every once in a while when someone has a big ICO or something else and people feel like they're getting ripped off, then the SEC has to make it a Reg A. And that'll happen with the next utility, and then they'll come in and regulate that. So while it's small and under the radar, it's interesting. But if someone, one bad apple harms the game.
Interesting. Now, one of the things that we've talked about is, or we focused on so far, is on the sales and trading side. I want to give some attention also to the advisory side of investment banking and where that is evolving, what the advisory bank of the future looks like, what does M&A look like in the future. So let's start with that sort of general worldview. And Howard, maybe we'll start with you, if we can get your view on that.
Sure. So once upon a time, they picked on investment managers for churning, right? In order to make commissions, they trade you more often. Now, here's a topic for you probably haven't thought about much. Reverse churning. What's reverse churning? I charge you a 1% management fee. And I do absolutely nothing. I put you into a 5-year thing, and I sit back like this. And the regulators are going to say, now what in God's name are you getting, right, 1% for? Right? That's reverse churning. So what's going to happen is asset managers are going to have to sing for their supper.
Yep.
They're going to have to move you around. Now it may be the dun 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 dun. Hey, right? I sell you one, you sell him, I sell to you. We sort of move it around, but what you buy and what you should buy, right, should really be about you talking. Because whatever model they're using now is not as clever as what a machine can do over time. That is for darn sure. So maybe you should talk a little about where we're going with deep learning and how that can work in investing, because the way it's done now it's entertaining.
Yeah, I mean, I think sort of, if you think about AI and deep learning, it's all about learned experiences. And so as we look at the volume of data that we have that reflects upon the history, that can inform the future. I think the biggest risk is that we inform the future properly and not with too much of a backward-looking view. And then the second biggest risk is how do we know the future was informed properly, right? How do we know that what's the result of this learned system is actually what we intended and what we wanted, right, as a society, which I think is a really important vector in that. But technologically, we're there, right? The technology is there to support the speeds of computing necessary at the scale necessary to outstrip our ability to reason about the result, which is fascinating and very dangerous at the same time. So we always, at Microsoft, we talk about ethical AI very specifically for that reason, because we want to ensure that the trained systems are not reflecting internal biases that the trainers had.
But I'll do it simple for you, which is, would you agree that, so I'm an asset manager, all right? And I'm looking for what I think is the best relative outcome of this type, right? And I'm limited to the fact that I can study 10 or 12 or 15 opportunities. And so I've always viewed it, if you give me 10 opportunities and I pick the best one, and the machine checked 20,000 opportunities and took the best one.
Yep.
If I could do 20,000, I promise I'd pick a better one. Right? So the idea is eventually machines will look for this opportunity the broadest way. Now the risk, of course, is if I said, find me the cheapest BBB- bond, it's a piece of crap that's about to go to zero. Right? It just hasn't gone there yet.
Yeah.
So it needs to actually be clever.
So that makes some sense to me that from a universe of 20,000 instruments, an AI system can do a pretty good job picking. When it comes to portfolio management, I would be a little bit more concerned. Do I want my portfolio constructed by a machine? Do I want my portfolio continually rebalanced by a machine? Maybe the data came from a normal economy period, and now we're in a risk-on, risk-off period. Maybe quantitative easing has suddenly hit the world, and we're in a totally different regime. So I did 10 years of robotics, machine vision, and AI, and I expect that these things are really good in their in the domain that they understand, but people get slaughtered at inflection points if they're relying on trend systems or essentially systems that were trained on historical data.
So what you're saying is that the models that are all just AI driven are massive inflection point
I'm saying
risk.
the world's going to keep changing,
Yeah.
and you need a lot of different kinds of expertise to try to recognize when those inflection points are just about to come about, and it's very hard to do that sort of thing.
So don't you want your AI to be a piano, right? With all the capacity of a piano, but you still need someone to play the piano, right?
Well,
Move me from here to
I
there.
think that's right. Yeah.
Right? They need to be the piano. If
Yeah.
you just let the machine do it,
Yeah.
it'll continuously make the same mistake that it just hasn't seen yet.
Right.
Yeah.
I mean, we've seen a big growth of robo-advisors in the private wealth management space to help asset managers build out market share, and they work very nicely with a shift to passive investing. But what we've seen is you may have a passive investment, but you actively trade those passive investments. And so this idea of, oh, well, if you just put your money into an ETF, it'll do well and it'll beat some guy who's, throwing darts and stock picking. That's great unless you as an untrained individual try to time the market and trade that ETF, and you end up screwing it up that way. And so we've seen that happen over and over, that the people who actually capture the returns aren't able to, even when they say, I'm going to turn it over to a computer, they then try to control the computer at all the wrong times and put those biases right back into the process.
Look, 95% of all returns are by asset allocation. And 5% is which asset you pick, right? So whether you bought Microsoft stock or not, it's not really the issue. Did you buy stocks, right? It's just binary. So 95% is which asset class you pick. So, machines will do again, amongst decisions, they will get more choice, and therefore they'll do a better job amongst choice. And therefore I think it's going to add tremendous value. And think of the army of people who work in asset management, right? That army will continue to be improved output with much less people, but you still need the top. You still need the piano players telling you should be in this asset class and not that asset class. That's just clever.
Sure.
Is that actually better, having a person do that, than a machine doing that asset allocation? I'm not convinced that a person does a better job. Maybe there are some people who do a better job, but I'm not convinced that on average that's a better task for a human.
What Yorke said is that, and Joe said, it's the inflection point moment.
Right.
Right? It's when the machine says, keep driving, don't worry about the cliff. Right. Don't worry, the cliff is not really there. Right? Someone's got to say, you know what? I'm not so sure that I can validate that outcome, because we are not yet smart enough. Right? The machine is smarter than we are. And therefore, when the machine says the answer is 12, I don't know if the answer is 12.
Right. So do you think, in general, on average, the retail investor benefits from anything other than just asset allocation? Should the money just be put into the market and left? Because my feeling is that unless you have an edge in the markets, and that comes from essentially people situations, you are pretty much just churning your portfolio. It's unlikely that you're going to make systematically better decisions at the right times. And so should retail investors not be active?
Look, since my opinion is 95% of all returns are asset allocation, you're supposed to spend time thinking about which class you put it in. Put your fingers out, you have 5 choices. You can do stocks, bonds, alternative investments, cash, right? Or one other thing where you can speculate on
where you
whatever
are
you want.
at your stage in life, choose a portfolio
But
balance.
moving around amongst that pile is okay. If you're messing about which stock to pick, you're just having sport.
That's true.
But there's no outcome based on it. It's just sport. But amongst those 5, that's what you're supposed to think about.
I think as we think about democratization of markets, right, that concept is that we're going to reach many more potential retail investors. And a typical retail investor of today is not really an investor. They're not an active investor. They make the following choices. I work for Microsoft, therefore I have Microsoft stock, right? Whether or not I wanted it, right? I have a, potentially a pension plan, which is going to be invested in some, amalgam of stuff, right? I might have equity in a home. It's very unlikely I have a bond at this, that particular stage. So those are your allocations, right? As a democratized retail investor, that is, I think, the new frontier, right? As we broaden this market.
I mean, my personal view, and I'd love to get your take on this, is that investing is largely about predicting the future, right? And predicting the future, you can try to build an Excel model, and you're going to put in, I don't know, say 10 inputs into it, and maybe those are precise, maybe they're not, but the universe of possible inputs is probably a million things, a billion things. I don't know. It's some huge number that there's no way a human can make an informed prediction about a billion things or even 10,000 things. And so it's, yes, maybe a human can do a really good job researching 10 things, and maybe they even have a strong view that those are the 10 things that matter most. But I think a computer is going to be better at predicting, with AI and machine learning, those other million inputs. And so I guess the question is, are you going to continue to see a shift towards that, to the computers making the investment decisions? Are you simultaneously going to see the HFT guys or the quant investors, are they going to take market share here? Are they going to have a longer time horizon, much as a human investor maybe did previously?
Well, I think you just made a case for a new type of investment bank marketing, right? You just made a marketing pitch saying, hey, the machine will do a better job, right? So pick us because our machines are cool and smart and they'll do a better job for you.
Built with Microsoft.
But that's marketing, and someone else will say, right, someone else will say, well, I have it too, but I have managers playing the piano,
right.
choosing where to go. But it all is going to underline with, eventually inputs are better served with a computer analyzing them, right, over time, and being the output to how you should invest, for sure. But again, since 95% of the money is just which bucket you put it in, it's all entertaining for marketing. Because in the end, do I think interest rates are going up or down, right? Do I think equity markets are going up or down? Do I think real estate is a good investment or not? Right. Call it a day. Right. Those are the three choices. And if you put it in one of those three, and besides, most people, they own their house, right? They have a little bit of stock in their pension plan, and there's not really much choices, so they have it, at the edges. So I think the model is going to be, in asset management, I think AI is going to do brilliantly well to do a better job solving the exact same problem they're trying to solve today. Just do a better job of it.
Agreed.
And I'll be more precise at giving you exactly what you want, and if exactly what you want may or may not be smart, right? But they'll at least give you exactly what you want.
So if you, for whatever reason, decided to manage your own portfolio, would you read human analysts?
So here's what I think people should do. They should pick the smart people that they know, and once a quarter talk to them, right? And amalgamate their ideas. And if you spend a lot of time watching TV, right, about this and this and this and this, you're missing the point. Which is talk to all the smart people and say, what do you think the economy is going to do? What do you think interest rates are going to do? What do you think this is going to do?
Sure.
And amalgamate those smart people, make your own decision, put it in your own life, right? And then set up your 5 choices at best for this quarter, and I'll see you next quarter.
So bringing it back to blockchain, there's a reason why I asked that question. We have a project called Helena, which is essentially a platform to enable analysts to share their work, and something called a token curated registry. So the better analysts end up much higher in the list, and there's money gets pumped into the system by people who
better by historical performance.
Yes.
By the judgment of people who are reading the work.
Okay.
Simply that.
Just opinions.
And
So they're
yeah,
voting.
exactly.
Effectively like
so
an effective
money
vote.
gets pumped into the system by people who want to pay attention to this stuff, and they're voting on who they like the most, and the money gets allocated that way. And you could certainly have an AI being one of those analysts, anywhere in the list. So I like that system because I think it's devoid of conflict of interest, and I think it has the potential to source a broad array of opinions and enable sort of a fair playing field. Anybody who wants to take a look at this research, pay for this research, reward the people that they like, will be able to use that sort of system.
I like that.
Yep.
I want to make a point about the democratization of sort of the retail consumer,
now?
and look at the blockchain space as a case study, right? You could look at like the typical
Keep talking. Don't worry about it.
20 minutes.
I was trying to get his attention.
I got to run.
Oh, okay. So before you run,
Yes.
I'm going to use a ConsenSys employee as the retail investor. So a ConsenSys employee is essentially invested in a illiquid asset, right, called Ethereum. Works for a company in the blockchain space, and so they've sort of put all their eggs in one basket, right? When you think about that type of retail investor, so they're definitely like way over on the side, right, than Joe consumer, that owns a home, et cetera. So I think it's when we look at edge cases, it's actually this market as a future retail investment market is actually I think it really interesting to look at.
Okay.
I know you have to run.
He's leaving, but we're staying.
We're staying.
So it's okay.
Apologies. Thank you, everybody.
Thanks, Joe.
Thanks, guys.
Nice to meet you.
So, maybe we could shift gears a little bit and talk about the M&A market and where you see that evolving and how you see the role of an investment bank in that market changing over time. I think that's an area that is going to be of interest to a lot of folks.
Well, so, if you look at the core of M&A, it starts with analysts just who never see the light of day, right? They never see the light of day, and so I have a friend, Bob. He runs a company, and so I'm a banker. So I pitch him, hey, I was thinking, do you want to buy company A? And he says, gee, I don't know. I said, all right, I'll let you know on Monday. And then I call my young guys and say, do research on company A. And then we give him a whole pitch on company A. He says, nah. I say, hey, how about company B? He says, oh, maybe. Do some work. And that's why they never see the light of day.
Right.
When I was a junior investment banker, they called that Project Spaghetti because you just throw spaghetti at the wall and see what sticks.
Right, but eventually, when you say yes, right, then now we have a project.
Right.
Right, but I pitched it, and I get credit, right? And now the world of work comes in, and that world of work has armies of people who are doing effectively lots of donkey work, right? And donkey work, whatever you do in the world of investment banking that's donkey work, right, needs to be done in a different way, right? If it's intellectual, okay, that's further down the path, but just going checking boxes and double checking this and double checking that, I mean, that's got to go the other way, right?
Yes. Oh, absolutely. Yeah. I mean, anything that's donkey work is, that's maybe being done in Excel,
Right.
is certainly, ripe for automation and, more inputs, more optionality on the outputs. But I think going back to what you're pitching is sort of on the sales side of the equation, right? It's you're pitching based on what the person you're pitching to really is interested in, what they want, right? So that's sort of the human element of that.
And there's potentially, I guess, room for using technology to enhance the quality of that pitch, to make a not I don't mean a better presentation, but to find a better idea through AI. So instead of just saying you want company A, you want company B, maybe you can find some sort of matching engine of some kind that can say, what, company A really is a better fit for you. Or I can prove to you that you should buy company A because I've done a better grade of research there or something like that.
Well, but we all know that acquisitions work or don't work via after the acquisition, what the integration is, right?
That's right.
Always, lots of good companies buy lots of other good companies and kill them,
Yeah.
right? Because
Yes.
they just choke them to death or do all sorts of things. So I think That's a good sales pitch again, which is instead of saying I got my young guys to go work on this whole weekend, right? I had my massive Yorke design computer, right? Do all this research, and this is cool. But in the end, do you want to buy it or not?
Right.
And then the reason you'll use me as an investment bank, right, is because I will lend you the money, right? I will lend you the money to buy the company first. That's always helpful, right? So if you lend me the money, I really like you, right? And that's the idea. So advice is one thing, because people need advice, and they pay a certain amount for advice and guidance. And credit is another. And the big banks have a lot of capital, and they give a lot of credit. And credit, could be democratized, I guess, like insurance. But insurance will be democratized way before credit. Right? Is a hurricane coming? Right? Right now, can you raise money in the public markets to fund that? We'll see. Eventually, maybe, but we'll see. Do people like to get paid a penny? And when a hurricane comes, you lose $1.
That's happening in Joe's company. The Gnosis market is actually doing that kind of thing, where people are betting on outcomes, whether it's presidential elections or hurricanes landing on a particular state in the United States, which is really, sort of back to the point about this technology has a democratizing impact, where Joe consumer who never thought about investing in anything in their life before now has an opportunity to an access to a new asset class, which in that case is effectively just a bet, right? Right. Howard, do you see, from your perspective as you look into the future of your company, how you might see yourself participating in these, new illiquid markets?
Well, so we, because we're a wholesaler and everything, we have a fully approved futures exchange. So, for example, we have a market now for weather futures. So fully approved in all 50 states in America, where you can bet on whether it's going to be hot or cold, it's going to rain or not rain. The most popular thing we have now is snow. Will it snow an inch in your zip code?
It's pure speculation, though, right? Is there like an actual business value to
the
this?
idea is eventually to have it be hedging, right?
Okay.
If it's too hot, I have to pay for air conditioning. If it's too cold, I have to pay for heating.
Okay.
Right? Hurricanes are all about insuring my plants.
Sure.
Right? Because the hurricane comes through, I can have hurricane insurance, but my shrubs all get ripped up. I can't insure that. So those models, but those are me really messing around, trying to play around with what is going to excite people. And I don't know if those markets are big enough. But what it does is it informs a way of thinking on the big financial service markets. And how do you create new markets and big markets that people will participate in and like? Because in the end, cash markets have become very automated, right? Equity markets, fixed income markets will become more and more automated. And the reason the banks are letting it do that is because they make their money on derivatives. And they want the cash markets so they can hedge cheaply, right? If hedging were free, meaning the world was so deep and so liquid that I could hedge perfectly for free, then I could do a foreign exchange option for all of your companies, and it would be great for me, right? Great for me being the investment bank, because I could say, let's say you want to hedge your 1 year forward.
That risk. Yeah.
Right? I could hedge it cheaply. And the more expensive that hedge is, for me, the more expensive I have to make it for you. And so they've seeded the trading, not the traders haven't seeded it, but the intellectuals at the top of the banks have decided that trading will eventually go to machines and may well not be their machines. But that's okay, because hedging will become cheap enough that they'll make it all back in their derivatives, which is where they make their money. Because in the end, if you have $80 billion or $250 billion of capital, little things don't really make a difference. I need to make $25 billion. I need to make $2 billion a month. So I've got to play in big games, in big leagues, for big money, or it doesn't matter. And people tend to forget that investment banks have lots of capital, and that's what they're using. They're using their capital to make money. And then lots of times we talk about all this little stuff. I'll give you an example. The equity markets, right, are a support system for prime brokerage and investment banking. people don't make money trading stocks. It's a support system. And when you realize, oh, really, it's a support, so we're spending all this time talking about it, and the banks view it as a support system to feed all the other things of where I make my money? And those two things, they use their capital.
Makes sense. Maybe we could take a question or two from the audience if we've got them. Yeah, please.
Well, so we'll take it in two directions. So I think the settlement processes, so everything that we haven't talked about today, eventually will be blockchain will participate in. All the settlement processes, right? Because why is it T+3 settlement? God, why isn't it T plus an hour?
Right.
You know, just in case it messed up, but give it an hour, let's do it. So that needs to have validated. So I think blockchain will play a fundamental role there. I'm not a big bettor that it's going to be disrupted. I think the incumbents who have the trust mechanism, right, will create much more efficient processes and will implement it. So I think that's going to happen for sure. I have a fully approved futures exchange, and the reason when cryptos were going crazy, the reason I didn't bring out a product is because I couldn't assure myself that the settlement price at the end of the day was a real number, right? Like you're going to trade futures with me, and at the end of the day, it has to touch a reality point, right? And we're going to settle it at 4,624. What if that number is just make-believe? Who am I relying upon to set that number? And if I'm relying upon an exchange that I don't think is true and honest, then I can't participate.
So would you get into an exchange business then to hedge that?
Well, I'd have to, but then you have to be, since it's a retail-based product,
Yeah.
and I'm one of the great wholesalers of the world, the
Yeah.
problem is I'm not one of the great retailers of the world. You know, if Jeff wants to call me from Amazon and says, let's partner, I'd be psyched, you know, but I'm not a retailer. So I can't build that because I'm not good at that.
You need advice that you trust, right? That's what I take away from that is there is not a brand in the space yet that gives you credible advice. If you want merger advice, you can go to Goldman Sachs or Cantor FitzGerald or Morgan Stanley, and okay, they're a real guy, I can trust their advice. But when you're doing something new, there's going to be a lot of people with a lot of opinions, and who knows which one is the right one. Right. Great. All right. I think we're going to need to wrap.
In America, it would be Reg A, meaning think of a regulated way to do exactly what you want. Okay? If you try to do it outside, you're on the edges. You don't want to be on the edges. It sounds like for you, you want to be right down the middle. So make sure you're in a regulated environment that allows you to do it your way. In America, that would be called Reg A, right? In Europe, they don't have the same rule yet, but they will.
Great.
Great. Thank you.
Thanks, everybody.